Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
We have to open today by talking about the most spectacular and fraught price action we've seen in the distressed equity markets in a while. I'm talking about urban-gro, UGRO. This is not ordinary movement. We saw a sudden spike of, over 16% in just 2 days, December 17th and 18th, 2025. And it was driven by a complete explosion in volume. I mean, we're talking about 96 million shares traded. 96 million. Compare that to the 3-month average of just 5.7 million.
And that volume, a 16-fold increase, that is what demands scrutiny. Because we are not discussing an operational company here. Let's be clear. We're discussing a structural shell. UGRO has, for all intents and purposes, capitulated on its original ag-tech business and now exists purely as a vehicle for a reverse merger with Flash Sports and Media. So the central question, the real question is, what this extreme price and volume action truly signals. Is this the footprint of credible, sophisticated merger arbitrageurs betting high on regulatory compliance? Or is this just transient algo-driven noise, what I would call market microstructure noise, in a fundamentally broken company that is facing imminent delisting?
I think focusing on the broken entity part of it really misses the point, because the entity's value is no longer derived from its operations at all. My position is that this massive volume spike is a rational, if highly leveraged, wager on the successful execution of the regulatory process. The market is pricing the inherent value of that NASDAQ listing, which, it currently outweighs the failure of the legacy business. This is, at its core, a bet that CEO Suren Ajarapu can pull the company through the December 31st compliance deadline.
See, I come at it from a completely different angle. I view this spike as purely speculative froth. It's a news vacuum rally that aggressively ignores the structural realities on the ground. The operational collapse has been total, and the agreed-upon terms of the merger, they mandate such severe dilution for legacy shareholders that any current price appreciation is completely detached from the eventual outcome. The stock is reacting to momentum, maybe the fallacy of the short squeeze, not genuine institutional conviction that the paperwork is going to clear.
Okay, but let's look at the foundational argument for my position, which is the valuation. We both agree the valuation is derived entirely from the utility of the NASDAQ listing, right? It's the price tag on the ticker symbol itself. The company's actual business performance, it's irrelevant now, especially with trailing 12-month revenue contracting by 17%. But the scale of that volume explosion, 96 million shares, that suggests something concrete is happening. These are sophisticated traders positioning ahead of that binding December 31st deadline for filing the delinquent 10K and 10Qs. This volume is the market betting on what you could call the clean merger scenario.
But the structural collapse is the context that defines the shell's risk, even if the shell itself is the asset. You can't just discount how structurally impaired this vehicle is. The rally is fundamentally unsupported by any measure of solvency or operational stability. We have to look at the evidence of the company just stripping itself bare for survival. The foreclosure on the $10 million Gemini finance facility, the seizure of key assets from the UG construction division, and the desperate sale of their 2WR subsidiary, which was actually a vital revenue generator, for a paltry $2 million. This company isn't being streamlined. It's being liquidated for parts just to keep the listing alive.
But those actions, as desperate as they are, they prove the singular focus here is survival of the listing vehicle. And look at the commitment from the incoming partner, Flash Sports and Media. They paid a $200,000 refundable deposit. That acts as necessary life support capital. It demonstrates a concrete financial commitment to completing the transaction and securing that NASDAQ status. The current price, it reflects the highly leveraged value of a call option really on the CEO's ability to navigate this extremely complex regulatory labyrinth.
The cost of that execution, though, is devastating for current holders. It doesn't matter how good the CEO's deal-making is, let's just look at the financials. Not for revenue, but for value destruction. Trailing 12-month return on assets, TTM, ROA, plummeted to negative 24.3%. That isn't just distress, that is active, verifiable destruction of shareholder value over the past year. And crucially, the definitive terms of this merger, they mandate a massive 90% dilution for legacy shareholders. It values the existing UGRO business at roughly $5 million, which, as you said, is just the cost of buying a public shell. Any current price appreciation ignores the reality that current holders will be reduced to a 10% minority stake. That's a fundamentally unsound basis for a 16% rally.
We have to stop conflating the compelling operating history with the arbitrage opportunity that's presented by the regulatory process. The core contention here is how we interpret that massive volume figure.
And I believe interpreting that volume as purely directional positioning is a mistake. Let's dig into the market microstructure anomaly at play here. We've seen the off-exchange short volume ratio often exceeding 50, even 60% on days like December 17th and 18th. This high percentage, well, it suggests sophisticated players, like holders of convertible securities or the Gemini settlement shares, are hedging their positions or liquidating inventory. And they execute these huge trades in dark pools to avoid immediate price slippage. It's inventory management creating a shadow supply, not necessarily fresh, directional buying.
Okay, I understand why you focus on that shadow supply. That level of off-exchange shorting is certainly indicative of careful inventory management and a low-float, distressed stock, which is exactly what UGRO is. However, framing it as structural bearishness, I think, misinterprets the data. The total reported short interest percentage of float, according to Fintel, is only 5.73%. That figure directly contradicts the idea that institutions are placing massive structural shorts against the company's survival. The daily high volume is transactional, yes, but it is reacting to directional buying driven by that approaching deadline, a major move of 16% on 96 million shares volume. That suggests genuine high-stakes positioning by people who believe the compliance boxes will be checked.
But the mechanism of that selling pressure matters. It matters intensely. When liquidity providers or creditors unload their shares using continuous shorts and dark pools, they effectively cap any organic rally. Every single uptick based on retail momentum is instantly absorbed by this persistent shadow supply. The volume we're seeing isn't necessarily arbitrage betting on a successful merger. It could just be retail chasing a signal, while the sophisticated players use that volatility to liquidate their own holdings, quietly and efficiently.
Which brings us directly to the most critical factor, the binary risk of the December 31st deadline. The very fact that the NASDAQ hearings panel granted UGRO an extension until the end of the year is proof. It's proof that a clear, actionable path to cure the 5250C1 filing deficiency exists.
Okay, hang on. Let's just clarify that technical jargon. The 5250C1 deficiency simply means they haven't filed their fundamental audit documents. The 10K, the 10Qs. Missing that is. I mean, it's missing the most basic rule of being a public company.
Exactly. The risk is binary, yes, but the potential reward justifies this speculative volume. If the merger closes, we're looking at a post-split price reset that could push the stock to $5 to $7 as the new entity Flash Sports begins trading. This isn't theoretical. The company showed its capacity to use these mechanics before, with a 1-for-6 split back in 2021 specifically to maintain compliance. The playbook is known.
The playbook is known, I agree, but the risk-reward ratio is just profoundly asymmetrical. It's heavily skewed toward catastrophic failure. If those delinquent audit filings are missed or rejected on December 31st, the stock faces immediate suspension and delisting. It gets shuttled off to the OTC pink sheets.
Which are?
The OTC pink sheets are, well, they're the basement of the public markets. They are non-reporting, non-compliant, basically where companies go to die, financially speaking. And that outcome instantly wipes out all institutional liquidity and renders the NASDAQ shell utterly worthless to Flash boards. I mean, why would Flash complete a reverse merger to gain a pink sheet listing? They wouldn't. So the risk of failure is existential. Anyone buying based on a 16% rally is gambling on a coin flip where one side pays a little and the other side pays zero.
But that risk assessment ignores the incentives of the other party. The whole arbitrage thesis centers on the commitment to file, which is driven by Flash Sports' intense desire to secure a NASDAQ ticker. That $200,000 deposit shows they have serious skin in the game. They have every single incentive to pressure Surin Ajarabu's team to finalize those audit documents, even if it means extraordinary measures. The risk of delisting is high, sure, but the commitment to avoid delisting is equally high.
The commitment might be there, but the consequences of past debt settlements have created these fundamental headwinds that cap any rally even if they file successfully. We have to address the dilutive consequences of the Gemini finance settlement from back in September 2025.
Well, the debt settlement was necessary to avoid a larger bankruptcy.
Yes, but the amendment fee, it was paid with 150,000 shares issued to the creditor. That wasn't a static, one-time cost. That single action created a persistent offer in the market, a steady stream of selling pressure. That lender has zero incentive to hold the stock. They liquidated immediately to recover their principal, regardless of the merger status. This liquidation acts as a constant ceiling on the stock price, making that December 17th spike fundamentally unsustainable.
I acknowledge the dilutive pressure from the Gemini shares. I do. But we have to view that strategy as a calculated necessity. Issuing equity to creditors was the only feasible way to avoid a broader bankruptcy filing, which would have instantly destroyed the one valuable asset they had left, the NASDAQ listing vehicle. It was a strategic trade-off. Suffer targeted, manage dilution now to preserve the merger vessel for the future. The goal was to clear the deck for flash sports, not maximize current shareholder value.
And clearing the deck has led to an inevitable final step, the mandated 1-for-15 reverse split in the letter of intent. Now, while this is technically necessary to cure the bid price rule violation, getting the stock over $1, historically, this is a profoundly bearish signal in a distressed company. It may be a technical requirement, but it facilitates new shorting by institutional desks that are restricted from trading sub-dollar stocks. It just creates another headwind.
But that historical bearish signal applies to an operating company attempting a turnaround. UGRO is not an operating company. It is a merger vessel. Arbitrageurs view the reverse split not as a desperate act of survival, but as the penultimate, necessary, mechanical step toward deal closure. The split is a compliance mechanic for the new entity, Flash Sports and Media, to make sure they meet listing requirements post-merger.
It is asking for an enormous amount of intellectual charity to overlook the long trail of financial failures and regulatory missteps just because a complex transaction is on the horizon. The sophisticated observer has to weigh the technical signals, like that massive volume, against the absolute structural risks.
And that is exactly where the distinction lies. UGRO is now defined entirely by regulatory mechanics and merger arbitrage potential. The volatility reflects the intense, high-stakes speculation on the outcome of the December 31st deadline. Investors are treating this as a pure special situation play. It's a complex wager on regulatory success.
Driven event that serves only to mask the reality of the 90-10 dilution and the operational collapse, until the definitive agreement is signed and, more critically, the delinquent 10K and 10Q filings are secured and accepted by NASDAQ, the company remains positioned precariously on the regulatory cliff.
The future trajectory of UGRO, then, hinges entirely on its successful transition from a failed business to a clean, compliant vessel. The price action simply reflects the high stakes of that gamble.
And we're left looking at a spectacular example of how the financial value of a company can be reduced entirely to its regulatory status, forcing sophisticated observers to constantly calibrate technical signals against absolute fundamental risk.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.